Equity and debt financing are two primary methods companies use to raise capital, each with distinct characteristics and implications for businesses and investors. Equity financing involves selling shares of ownership, equity, in the company to investors. These investors become shareholders and acquire ownership stakes in the business. They may receive dividends and have voting rights in major corporate decisions. This method allows companies to raise funds without incurring debt but involves giving up a portion of ownership. On the other hand, debt financing involves borrowing funds from lenders with the promise of repayment over time, typically with interest. Companies do not relinquish ownership through debt financing but must repay the borrowed amount along with interest according to agreed terms. Lenders have legal claims to repayment and receive fixed interest payments. The risk and return profiles differ significantly between equity and debt financing. Equity investors assume higher risk as they share in the company's profits and losses. They benefit from potential capital appreciation but also face the risk of losing their investment if the company struggles. Debt lenders, meanwhile, have lower risk since they receive fixed interest payments and are entitled to repayment of the principal amount, irrespective of the company's profitability. Cost considerations also vary between the two methods. Equity financing tends to be more expensive in the long term because shareholders expect returns on their investments through dividends or capital gains. This ongoing cost can be higher compared to the fixed interest payments associated with debt financing, which are typically tax-deductible for the borrowing company. In terms of flexibility and control, equity financing offers flexibility as there are no fixed repayment obligations. Investors may provide strategic advice or resources beyond capital, but issuing equity dilutes existing shareholders' ownership and can lead to a loss of control for the company's founders or initial owners. Debt financing provides certainty in terms of repayment schedules and interest rates, allowing for better financial planning. The company retains full ownership and control, as lenders do not have voting rights or decision-making authority. Both methods serve different purposes and are suitable for various financial needs and stages of business growth. Equity financing is often used for funding long-term growth initiatives such as research and development, expansion into new markets, or acquisitions. It is suitable for companies with high growth potential but limited current cash flow. In contrast, debt financing is typically used for short-term operational needs such as working capital, inventory purchases, or equipment upgrades. It is suitable for companies with stable cash flow and predictable revenue streams that can support regular debt payments. In conclusion, while equity and debt financing offer distinct advantages and considerations, many companies use a combination of both to optimize their capital structure. Deciding between equity and debt financing depends on factors such as financial objectives, risk tolerance, cost considerations, and the company's growth stage. By understanding these differences, businesses can make informed decisions to meet their capital needs effectively.